Oh, on the screen here, you have, now remember that I'm using PowerPoints from a different book just because the book that we're using for our class is older. That's not an issue at all because the concepts are the same. They haven't changed. It's just a matter of I can't get resources for this book anymore. I checked and they said no, they don't exist anymore. So I'm using resources from another book that I've used, which is the same material, so I just don't want anybody to be alarmed by that. So cash flow, let's talk about what that means here. And also net present value. So right here it talks about in yellow cash flows. We'll come back and talk a little bit more about that. But right here we're going to focus on net present value. Okay, it's basically the sum of all the cash flows received in the future from a project or an investment brought back down to the present value at some rate. So it's CF, cash flow, 1 year, 2 years, and a number of years. 1 plus R, and R is the required rate of return to the power of a year, 1 year, 2 years, and so on. It's that present value minus the initial cost of the project. Okay, so imagine that you want to buy a new delivery van for your business and you crunch the numbers. You find out what it will initially cost and you figure out what the future cash flows are from investing in that delivery van, because maybe now you're starting deliveries for your business and you've never done that before. And so you're thinking, well, I'm going to have a new revenue stream because of that. And that's what these future cash flows are. It's additional revenues, additional cash flows, minus the cost of those revenues also, that I'll have in the future because I'm doing this new project, brought down to present value at some interest rate. Subtract the initial cost, and if that number is above zero, it's a positive, there's a high likelihood that I would take on that project. Okay, so that's really what NPV is. We'll get into more details with it here, obviously. And then down here in the green, they talk about what that R is and what goes into that R. It's the project's risk-adjusted cost of capital, essentially the cost of getting that capital, obtaining capital so that we can buy that van. If that was capital that we received through a bank loan, capital from earnings that we've kept in our business and are just going to reinvest in this new delivery van, or maybe it's outside investment. Maybe it's we sold stock of a publicly traded company. Maybe it's if we're privately held, we found an investor willing to invest with us, and we told the investor, if you buy equity of our business, here's what we're going to do with the money. We're going to try to launch this new venture. So that's really what that's about. And of course, you have to factor in what is the market interest rate, what is the riskiness of the project, how certain is it. All those go into play to determine what that little R number is. Okay, and that's the required rate of return, the risk-adjusted cost of capital. So capital budgeting, if you've heard that term, and it's going to come up as you read this chapter, it's basically saying how do we decide what to do with our funds, and that's really the whole chapter is called resource allocation. So as we make more money, as we seek additional opportunities to make the company worth more, how do we do that? You know, what's the process we go through to invest in the right kind of projects that will give us the best return for our owners. And remember that the goal of a finance manager is to make the company worth more money. You do that by investing in the right kind of projects. The hard part is when you do these kinds of projects, you can't just undo them. If you made the wrong choice, it's kind of like too bad. If it's building a new building, adding on to a factory, spending millions of dollars on new machinery or equipment, those are decisions that once they're made. You cannot undo them. And so clearly if you make the wrong decision about something very expensive, big problems. So that's why you have to really analyze these things and make sure you're doing the right thing. So capital budgeting involves estimating cash flows, both the inflows and the outflows. So with my delivery van example, clearly if we're going to start a delivery business, we've already have an existing business, but we're going to venture off into deliveries now. We're going to buy this delivery van and start delivering stuff. Okay. Clearly there's a cost to that. I have to buy the vehicle. After I buy the vehicle, I'm probably going to put my company's logo all over it so it looks nice and shiny and kind of advertise what I do. I'll have to have a driver. Obviously gas, maintenance, things like that. As vehicles are driven more, we're going to have to replace certain things that'll wear out, like brakes and whatnot. So routine maintenance, for hopefully nothing bad happens to the vehicle. We have to buy insurance for it. So you can kind of just sense the inflows and outflows there, right? The inflows are going to be me getting paid for delivering things, but the outflows are all the cost of operating that van, along with the driver and maintenance, all that kind of stuff. Okay, so that's the cash flows, the inflows and the outflows both. And then I have to think about what's the risk of that cash flow, right? How risky is this business? Obviously I'm not going to launch this business or this branch of my business unless I feel like there's a source of revenue there. I'm not going to just do this and hope for the best. I should obviously be doing some market research and analysis. Is there a need for this service? Will there be customers? Things like that, right? So I got to figure out, once I start this, how quickly will this be successful? Will it take a while or not also? So that riskiness is, how successful do I think this will be? I determine the R, that required rate of return, which is called the WACC for the project. And the WACC stands for weighted average cost of capital. Weighted average cost of capital. Essentially, the cost of obtaining capital for my business. All sources of capital, debt, equity, retained earnings, whatever that would be, that's the weighted average of all that cost. And then I evaluate the cash flows. Obviously, there'd be a big cash outflow to buy the van, put advertising logos on it, my company name, all that good stuff, get it ready to go, maybe even some money for advertising so people know, hey, I'm doing this. And then I start to deliver stuff and I make money, right? So there's going to be that initial big cash outflow and hopefully future big positives. And just some examples of the types of projects we're looking at. And I just kind of gave you a really simple one as an example of, let's just kind of launch this new little sub-business for our existing business by delivering stuff, delivering items in our van. But it could be maybe 5-6 years down the road, that van is getting worn out. Maybe it's not as reliable anymore. Clearly, if we're going to be delivering things, we need a reliable vehicle. And so we go through the process of analyzing how to replace it. That's a replacement. Maybe we can find something that's more fuel efficient, save us money. Who knows what it is? Maybe something that's even bigger, because maybe we need a bigger van because of more demand and whatnot. Sometimes it's a replacement to reduce cost, maybe a new machinery that's much more efficient. It would reduce labor cost, to reduce spoilage, expansion into new markets or products, contraction decisions. Do we just bring our business back? Do we reduce the size of our business, believe it or not? Sometimes you have to think about safety, environmental projects, mergers, and then all kinds of others. So a project can be almost anything. It can be something that's brand new, we've never done before. It can be making something better. It can be contraction, almost anything. And then also we have to think about projects if they are mutually exclusive or independent. An independent project means if I accept this project, it does not affect anything else. It only affects this project. Mutually exclusive means if the cash flows of one can be adversely impacted by acceptance of another. And probably the best example of mutually exclusive would be, let's just say you have a business in a town and you're thinking of expanding by building another business in your town. Where I live in Sioux Falls, South Dakota, we're a pretty good sized town. Our metro area is about 250,000 if you include the smaller towns around us that people commute to Sioux Falls from. And let's just say I've got the west side of Sioux Falls and the east side. This is kind of how we split. I-29 kind of divides us a little bit, and kind of the west side, east side. So the west side, let's just say I built my business on the west side. It's doing really well. I'm selling plenty of stuff, all kinds of customers. I'm doing well, and I want to expand. So I'm thinking, well, logically, then I'll build on the east side. I get a whole bunch more customers over there. There's a whole bunch of small towns on the east part of Sioux Falls that people will come to that location. It'll be great. Clearly, if I do that, customers that came to my store on the west side are not going to come there anymore because they live closer to the east side. So I'm going to lose them. They're not going to come to my existing store. They'll go to the newer one that's way closer. It's all about location, convenience when you're going to stores, right? So That's what mutually exclusive means. It means, yes, I'm going to add a new location because overall I'll have more customers, but I'm not going to double my growth right away necessarily because customers I already have are not going to come to my older store. They're going to go to the newer store. So that's what mutually exclusive means. It means I have to factor that in when I add a new location, that my existing store, that growth or the sales of that store may be negatively impacted. And so they're kind of just walking us through what that means. And they're giving us two examples, L and S. L for long, S for short. And just to show you two different examples. This is what they call a timeline approach. And so CF is cash flows. And then, so both of these, we're investing $100. That's the negative. Typically, you have that first year times 0 is negative. It's a cash outlay to invest in a project. And then I get future positive cash flows. Notice this one goes 10, 60, 80. The big year is the last year of the project. S goes 70, 50, 20. The big year is the first year of the project. And both are using the 10% weighted average cost of capital, or the R. The R in that formula we looked at is the 10%. And you can kind of just imagine time value of money. We haven't really talked about that yet in this class, but time value of money would say, the sooner I get my money, obviously the better off I am. So 70 brought down to 1 year at 10% is a much bigger number than 10 brought down to 1 year at 10%, clearly, right? So there's a big difference there between those two. And this is just kind of that same formula we looked at earlier. The only thing that we're adding now is the sigma formula, the sigma symbol, which is the sum. So basically the net present value is this bottom one right here. It's all future cash flows to the power of time divided by 1 plus r to the power of time, and the r is that rate, minus cash flows today. Okay, so it's the sum of all future cash flows taking in the factor of time minus the cash flows today. And that's what this next screen is going to show us with Project L. It's going to bring every single future cash flow down to a present value number today. And so if I invest 100 today, the present value of all future cash flows is the 10 down to 1 year at 10%, the 62 years 10%, and the 83 years 10%. And I take that negative 100, add in these three positives, I get a positive 18.79. That's for L. For S, it's a little bit higher. It's 1998. Okay, so the decision rule for NPV is, if it's positive, I would generally say yes. If it's above 0, I'll say yes, because net present value is a calculation of how much value are we adding to our company. If I take on this project, my company's value goes up by 1879 for L and 1998 for S. And if you're figuring this out on a calculator, financial calculator, that'd be the keystrokes that you would use. I'm a big Excel guy. I've used Excel a lot in my corporate career, and I use Excel because it's easy. You can save the Excel file. You can, pull it up and show it to somebody. Here's my calculation. And in my corporate career, almost everything I did had to be audited. So we made these kinds of calculations in Excel because you could document all your inputs, kind of show the calculation, give that to an auditor and say, here's the journal entry, here's how we came up with the info to book something or put something on the financials, or here's our decision tree that we used to decide to do whatever the project was. And they were okay with that because you can't really do a calculation on your financial calculator then show that to the auditor and say, here, they can't put that in their work papers. So I really began to use, in college when I was an undergrad in the 80s, I used financial calculators because that was all we had. But then I got in the corporate world and Excel had just come out, or some other spreadsheets, and just started using those because they were so easy to use and you could save them and all that kind of stuff and give them to auditors. So remember, the decision tree is right here. As long as the present value of all inflows are greater than cost, NPV is greater than 0, then generally I would accept the project. Now it says here, choose between mutually exclusive projects on the basis of higher NPV, which adds more value. So if I go back to my example of L and S, Over here, if these were mutually exclusive, meaning I could only pick one, I would pick S. Okay. If they were independent and I could afford to invest in both, the $100, yeah, I could do both then because they're both above 0. But if they're mutually exclusive, I would choose the one with the highest NPV. And that NPV is very dependent on the cost of capital. That will change significantly as the cost of capital changes also. Okay. All right, the next big one that we'll calculate is internal rate of return, IRR. And with both, and let me kind of just backtrack for a second. With both NPV and IRR, I will show you how to do those in Excel, just FYI. Okay, so that's going to be your big source of using these. And so internal rate of return is basically the discount rate. So it's a rate, internal rate of return. We're calculating a rate that forces the present value of all inflows to equal cost. Okay, so basically whatever WACC would force the NPV number to 0 is your internal rate of return. That's how that works. So essentially what you're doing is saying, what's all the future cash inflows? If they're discounted at whatever R, whatever that percent is, all those future cash inflows present value would exactly equal the cost of the project, and the PV is 0. So it's essentially a rate. And if you've ever heard that term, a hurdle rate, a hurdle rate would be my cost of capital might be 10% like we looked at. And so that's essentially becomes my hurdle rate. Any project that I invest in that gives me a return above the hurdle rate is going to add value to my company. That's really the way to think about that. And that's what IRR is calculating for us. So here's the formula for it. And it's a lot of the same things we looked at with the NPV formula, just rearranged a little bit differently. And it's basically saying the number, N is number of years, and then we've got the sum, T0, cash flows divided by 1 plus R to the power of T. And then here it's T0 equals NPV. So it's basically what is the rate, we're calculating what is the rate that will make sure that all of our future cash flows will come down to a 0 NPV today. And excuse me. So it's an estimate of a project's rate of return. And it's comparable to the yield to maturity on a bond. Now we haven't covered bonds yet, so I know you maybe haven't heard that. But yield to maturity is basically saying if I buy a bond and I own it until it matures, I receive a yield. And IRR is the same thing. I invest in a project, I spend money on a project, I see that project to fruition, however many years it lasts. If I invest, I get the cash flows that I expect to get, I get a certain return. So here's the timeline example of that. And so again, we invest $100, and then we get a whole bunch of future cash flows. And you can see what they are here. I get a negative 100, and then I get a positive 10, 60, 80. I bring those all down to a present value at some interest rate. And then whatever that rate is, it's the same rate that forces these 3 future cash flows, once they're added to this negative $100 investment, it gets them down to 0. Okay, and it calculates here for L it's 18.13, and for S it's 23.56. And again, I'll show you in Excel how to do this. Excel's got this really cool formula that'll do that for us. And they're using it right here with a calculator. If you had a financial calculator, they have those keys right here. A lot of smartphones, you can download an app that'll do that. Sometimes it's already on there depending on your phone. But nowadays, what I see a lot of people doing, just using their smartphones to do these calculations as opposed to having a separate calculator. So the rationale for the method is basically if the IRR is greater than R, essentially the weighted average cost of capital, you're good. Okay, so if I calculate an IRR of 15 and my cost of capital is 10, then I beat the hurdle rate. Okay, so I'm good. This project will add value to my shareholders. And again, I have to figure out, are these independent projects, or are these mutually exclusive? Both of them had very high IRRs. We go back and take a look at what they were, 18 versus 23.56. Our cost of capital, or the R, was 10, so they both are significantly above 10, meaning that I could take on either one and be good. Either one would work for me. So S and L are independent. I could accept both. If they're mutually exclusive, I choose S because its IRR is greater than L's. Okay. And this just shows you the relationship between the two. For independent projects, NPV and IRR will give you the same information. They will both say yes, accept, or reject. They'll give you the same answer if you're looking at independent projects. I did a lot of capital budgeting in my corporate days. We did both of these calculations and a few others, but we always did both just to corroborate that they worked. And because the people above me, the top officers of the company, they wanted this information anyway. You just kind of knew they're going to ask, okay, here's the NPV. Well, what's the IRR? If you didn't already have it calculated, they're going to ask you to do it anyway. But they always came back, if it's independent projects, with the same answer, which is good. It's always good to kind of double check those things. Now, this gets trickier too when you have different cash flow patterns. So just kind of FYI, a normal cash flow project is you have that initial negative and a series of positives, just one change of signs. However, depending on the kind of project you're looking at, you can have what they call a non-normal, which is two or more changes of signs. So an initial negative, a bunch of positives, and maybe a negative at the end. And they give an example here. Quite often, if you're getting a permit from the government to operate a power plant, a strip mine, anything like that, typically what the government wants you to do is set money aside so that when the project is over, you've got the funds available to then clean it up, to decommission the plant, put the land back with the strip mine, stuff like that. So typically that's pretty common example of what you would see for something like that. So the big negative at the end to put everything back together again. This is just an example of different cash flow patterns. The N is for normal, NN is for non-normal. You just never know, right? You just never know. With my delivery van, I would think that's a normal. I spend money to buy it. I get all my future positives, and then at some point in time, I either sell it or trade it in for another van. So it'd be a very normal one. Okay, so that was NPV and IRR. The next topic is cash flows. And that's really the two big topics in the chapter. So we're going to estimate cash flows and talk about what a relevant cash flow is. Then also talk a little bit about risk and options. So coming back to this here, we looked at cash flows earlier, the same slide we looked at earlier. And up here now we're trying to figure out what the cash flows are. In the examples we just got done looking at with NPV and IRR, they gave them to us. In reality, of course, you're calculating what those cash flows are. And you're also factoring in risk, right? There's that concept of risk and reward. The more risk I take, the more reward or return that I need in return for that. So that's what they mean by that. So we're going to focus here on cash flows and risk. So an example they're going to give us is we have a project, initial cost of $200,000, but then on top of buying it, we also have to pay for shipping and installation. So really, to get this project up and running, it's all of these three things go into that. So it's basically the cost of whatever it is you're buying, plus the cost of getting it to your place of business, installing it, getting it ready to work. So once it works, we have to think through all the costs to get to that point of now it works. Example I like to give is the newspaper in town where I live a few years ago bought a new printing press. And of course, with all things that are technology, they get better and smaller over time, right? Everything's like that, it seems like. But the old printing press, to get it out of the building, they literally had to cut a wall, and it was a concrete building. So they literally had to cut a concrete building, cut a big spot out, and get the old press out, and then put the new one in, and so on. So the cost of getting that new printing press ready to go would involve cutting the wall, getting the old one out, getting the new one in, installing it, putting the wall back, right? So all that stuff was needed to get it ready. So just kind of this, the example here is you include all the costs to get this item ready to work. The life is 4 years. Salvage value is $25,000. Essentially what it will be worth in 4 years when we're done using it. We think we can sell it or trade it in for $25,000. And the depreciation is called MACRS. It stands for Modified Accelerated Cost Recovery System, a 3-year class. Those are IRS tables. So basically, when you buy a fixed asset, you tell tax software or depreciation software, here's the kind of asset it is, and then that automatically knows to plug that into a certain tax table, and then it spits out the depreciation. So part of my project too is I'm going to have some sales. I'm buying this manufacturing equipment. I'm going to make something. I'm going to sell 1,250 units, sell it for $200. It's costing me $100 to make it. I'm going to sell it for $200. It says my net working capital, and so net working capital, just in case you don't know what that is current asset minus current liability. And what we're saying is that my net working capital will go up by 12% of sales. So imagine that you're launching a new product line. We're going to buy a bunch of equipment and start to make this new product. Think about current assets and current liabilities affected. I now have more inventory, a current asset. I'm probably selling this to other businesses. I'm going to sell that on account, so now I've got more receivables. On the flip side, I've got more payables. So that's that net working capital. We think that'll just go up. And it's very common that net working capital kind of grows organically. Just as your business will grow, you have more receivables, you have more payables, you have more inventory. It's very common. The tax rate is 40% and our cost of capital is 10%. And so we focus on what we call incremental cash flows. And incremental means what cash flows will change because of this project. So we only focus on what will change because we took on this project. Any cash flows that don't change because of this project are not included. Okay, so what will change? And a really simple example I like to use is, imagine I was looking to buy a new vehicle for myself. And I've got it down to 2 choices, and they're different for a reason. Let's go with I'm going to buy a Suburban, a Chevy Suburban versus a Honda Civic. Okay, and I can think about if I were to buy both of those, what I could think about is what's the cost difference of each one. Obviously, the Suburban's going to be more expensive than the Honda. The Suburban gets not great gas mileage, maybe 15 miles per gallon. The Honda's going to get 30 something. The cost of maintenance would be different. The Suburban has a bigger engine. Oil changes would be more expensive than the Honda. The Honda is going to be much lower to operate. Insurance would be different, obviously, for the two. So there's lots of cost differences with vehicles that are that different. But let's just say I work downtown and I pay $50 a month for parking. Well, that doesn't change, right? Doesn't matter what vehicle I put there. They don't care. The parking ramp folks don't care. They just know as long as I've got my payment and I've got my key code to get into the ramp, I can park any vehicle I want there. So that cash flow is not relevant because it doesn't change. So I focus on what's different. Incremental kind of just means change. What's different? So in this example would be, if I launch this new product line, what are my new cash flows versus if I don't do anything, what are my, whatever the cash flows. So that's kind of how to think about launching new products. And then financing costs is kind of a tricky thing here, so kind of focus on this. It says, should you subtract interest expense or dividends when calculating cash flow? And the answer is no. So even if I'm borrowing money to finance this new equipment, I don't subtract interest costs from that. Or if I'm selling stock of my company to finance this new equipment, I do not subtract that dividend cost from this. And the reason for that is that cost of capital takes that into account. So remember, in this example we're looking at, we're going to use a 10% cost of capital, and that basically just says that includes that. So that 10% factors in interest cost, cost of dividends, whatever that cost of capital is, that rate factors it in. Also, we have to talk about a sunk cost. And it says here for a sunk cost, suppose we had spent $100,000 last year to improve a production line site. Should this cost be included in the analysis? The answer is no. We want to focus on the incremental investment in operating cash flows going forward and not backwards. So if we spend $100,000 to determine the feasibility of this, that's good. We should, right? We shouldn't buy new equipment and make a big investment unless we know the product we sell or manufacture can be sold. Obviously, we have to figure that out. But that's a sunk cost. I have to decide, do I want to do that or not? So clearly that's pretty common. You don't spend a bunch of money on equipment in your product line to sell a product unless you've done your research to figure out, would this work? Is there a market? How much can I sell it for? What are my costs? Will this be profitable? Will this make me money? So quite often you do a feasibility study or something along those lines, and that feasibility study kind of gives you information to go, nope, not going to work, time out, not going to do it, or, oh, this is great, this is going to work, and we're going to do great at this. So that's a sunk cost. And another example of an incremental cost, it says, we're going to buy new equipment and put it into some empty factory floor space that we have. But it says instead of doing that, we could easily just lease out some of the space to somebody else, and we'd make $25,000 a year if we did that. So that's incremental, right? Because that's change. It's either lease it for $25,000 or buy a bunch of equipment and manufacture a new product. It's one or the other. And so it says here that would this affect the analysis? And the answer is yes, because accepting the project means we just gave up the $25,000, right? I can't do both. I can do one, I can do the other. I cannot do both. The opportunity cost, this is opportunity cost and should be charged to the project. The after-tax cost is what we focus on, and in finance we focus on cash, and cash is always after tax. So if I lease this space for $25,000 and I have a 40% tax rate, I net $15,000. So that's really what the opportunity cost is after tax, is $15,000. Then I think about externalities, and one of the externalities I mentioned earlier was I have one store in the city of Sioux Falls, is doing great. I want to expand at another location on the other side of town to hopefully make more money with two stores than one. However, I'm very aware that if I do that, customers who are driving all the way across town to come to my existing store won't do that anymore because they'll go to the new store that's closer to them. And so my existing store sales may be negatively impacted by the addition of a new location. So I wouldn't do that. So I have to figure that into account now before I make that decision. Should I add another store to the east side of town? The answer probably very well could be a yes, but I have to take into account the fact that my existing store sales may go down. I have to factor that into the decision. That's called an externality. And it says here, if we do launch a new product line and that results in new sales coming down by $50,000 a year from other products, would we charge that to this analysis? And the answer would be yeah, externality, because we better take that loss into account when we're calculating the cash flows and all that good stuff. So externalities can be positive or negative. An example of a positive externality, one that I really like is, now it's an older technology now, which is kind of surprising. But imagine, go back to when Apple first released iPods, and nobody seems to own iPods anymore because your iPhone does the exact same thing. But if you can kind of go back and remember iPods when they came out, what made them so popular was the fact that you could download a bunch of music through iTunes, right? And so the iPod without iTunes would have been just a hunk of plastic and metal in your pocket, right? So the positive externality is the fact that Apple, at the same time they launched the iPod, launched iTunes, so that you could make choices about music to buy and put that on your device and so on. So that's a positive externality. They complemented each other. Okay, so you have examples like that that obviously make sense. Now, you can also go with Apple. Once that the iPod came out well before the iPhone, and they came out with the iPhone, and oh wait, this can play music just like it's like an iPod with a telephone built into it. It does the same thing. So why in the world would you carry around an iPod when you've got your iPhone that does everything? So you don't, right? So obviously iPod sales have not done very well. So that's a negative externality between that and the iPhone. Okay, so for our equipment, remember that we have to factor in the cost of the equipment plus the shipping plus installation, all costs needed to get it ready to go. So that's what this is about. That's that 240. And then we have to depreciate that. And the reason we factor in depreciation is it impacts cash flow. Because if you can recall some accounting principles, depreciation is an expense, right? If I've got revenues, I subtract from my revenues depreciation to get down to a net income number. Same thing for finance is I'm focusing on cash flows, but I have to back out depreciation expense because it reduces my tax bill. But depreciation expense is also a non-cash item, so it's an expense that doesn't involve cash. And so we're depreciating this at these factors. The initial cost was 240 multiplied by the depreciation factors right there. And then what I do is I compute the sales. We're going to sell 1,250 units, and the price starts out at $200 and goes up a little bit every year. It grows at 6% per year. The unit cost is $100 in year one, but grows by about 3% per year. And so here's my sales number. Here's my costs. Okay, so basically my sales and my cost of sales are these. It says here, why is it important to include inflation when estimating cash flows? And it is important. Now, the good news is inflation's pretty low. It's been right around 2%, give or take a few basis points for the last about 20 years or so. It is low, but you should still factor it in. Now, you'll have a question. It doesn't say anything about inflation. Don't worry about that. There'll be a homework question where you're going to deal with that, but there's no inflation to worry about on that. But in reality, you'd think about that, yes. So basically just know that cash flows are impacted by inflation. If we're going to raise our prices because of inflation, or if our cost of goods will go up because of inflation, we got to factor that in. All right, so here is my cash flows then for years 1 and 2. And there's a really good example in your chapter 2 of this. So you've got an example here, and then right away in your chapter, that's on page 16 and 17. It's kind of 2 pages, kind of sideways. It's a really good example of a very detailed cash flow calculation. It's more detailed than this one, but if you want to take a look at that, I would highly recommend it. You can see here sales for the 2 years, our cost for the 2 years, and our depreciation, which we calculated a couple screens ago. That gets you down to what we call EBIT, earnings before interest and tax. So essentially your sales minus your expenses, both cost of goods sold and depreciation, is your EBIT. Then you subtract tax, which is 40%. So 40% of 45,008 is 18,003. That gets you down to your EBIT times 1 minus T, your EBIT basically after tax and before interest, and in this example we don't have interest. Then you add back depreciation to get down to your net operating cash flow. So depreciation is here twice. It's up here because it's tax deductible, right? That depreciation reduces my EBIT, which reduces my tax bill. But because depreciation is a non-cash item, I add it back. And so my cash flow was 106,997 and 119,922. And in finance, I care about cash. And we do the same thing for years 3 and 4. So you can see it goes I'm around here, 107, 120, then it goes down a bit, 94 and 89, mostly because depreciation is very high the first couple of years, and then it goes down. So depreciation 80, 107, and then it goes down quite a bit, down to 36 and 18. So this just shows us then our cash flow pattern. In year 0, this is for net working capital, I should say. In year 0, we're ramping up production of a new product line we've never had before. That means we are going out and buying inventory. We're going to start selling product and have more receivables. We're buying inventory and account, we'll have more payables, and so on. So just that net working capital of current asset minus current liability goes up, and they said it would be 12% of the sales number. And so it goes up right here, which means my investment in net working capital is now a negative. I had to spend money, a net $30,000 to acquire the capital needed to start this project, and then from there it goes down. And then the last year of the project, we recover that as the equipment is now obsolete. We don't use it anymore. We recover that working capital investment. We sell off all the inventory. We collect all the receivables. We pay all the payables, and now we're back to square one. And so we get a positive in the last year. We also mentioned there'd be a salvage value. We mentioned that when the project is done, that we could potentially sell this project for $25,000. Now we depreciated the whole thing away. We depreciated the 250 or the 250 plus the total cost away. Whatever, I forget off the top of my head all of a sudden what that was. 240, I think it was. We depreciated that away over the 4 years. And so if we sell this for $25,000 to somebody willing to buy it, we have a gain. It's all gain. So we should take the salvage value, subtract the book value. That's your gain or loss. If it's positive, it's a gain. Negative would be a loss. And so remember that we're paying a 40% tax. The tax would be $10,000. So my cash flow in year 4, the terminal year, is the last year, that's a positive 15. So I'll have an additional 15,000 in year 4 as I recover the salvage value. Now it says here, what if you terminate the project before the asset's fully depreciated? I just take the basis, and basis is cost minus depreciation. Cost minus depreciation, called book value. In accounting we call that book value, in finance we call it basis. It's the same thing. And taxes are paid on the difference between the sales price and the basis. Okay, so cash flow is sales proceeds minus taxes paid. So cash flow from sales, sales proceeds minus taxes paid. So in this example, let's just say we sell it after 3 years. The original basis was 240. After 3 years, after taking a lot of depreciation, we only have basis or book value of 17.8 left. We're still selling it for 25. My gain's much lower now, it's only 7.2. The tax on that gain is 2.88, and so my cash flow now is 25 minus 2.88, which is 22.12. And then it says here, what if I sell it after 3 years but only for 10,000, not for 25 but for 10? Now I have a loss. So my basis is 17.8. I sell it for 10. My loss is a negative 7.8. I lost money on that deal. I get a tax benefit for that though. The good news is I get a tax credit for that. And so that's a 3.12. So my cash flow now is actually 10 minus a minus, which is a plus, we all know, 13.12. Okay, so here's the net cash flows then. We'll just go back to the base case scenario here. If it costs 240, we'll hold it for the 4 years. So in year 0, I spend 240 for the equipment to get it ready to use. My net investment in working capital is negative. Makes sense, so it's a negative 270. Then I've got my future cash flows, right? So the cash flows from selling the product and the changes in my net working capital, which is 12% of the sales number. Then we got years 3 and 4 right there. So basically I spend 270 today and I get 4 years of future positives. So then I can plug that into a timeline, and you can see my timeline here, negative 270, all of my future positive years. Now remember that year 4 includes the recovery of our net working capital and the salvage value. So year 4 has got a nice bigger number here because of those. Plug those in here. We're using 10%. And if I go and calculate NPV, it's 88,000. IRR is almost 24%. So the answer would be yes to both. I should do this project. Both of them say yes. NPV is positive. IRR is above 10%. Now, we also have to talk about risk a little bit. What does risk mean? And risk is uncertainty, because remember, those cash flows that we did are all based on the future, right? Maybe we did do a study the year before, a market analysis to help us understand, will there be a future for this? Will there be sales if we build this product? Will people buy it? Will it be profitable? How much can we sell it for? And we did the analysis and we came up with, yeah, it makes sense. Let's run the numbers and see if this makes sense. But we're still dealing with the future. We can't take into account what the competition might do. We can't account for economy, regulation. There's lots of things we just can't predict for 4 years. You know, we can usually get the next year pretty close, but after that, there's too many moving parts in the economy that you just don't know how will things turn out. So that's the biggest challenge when it comes to capital budgeting, is you're projecting future cash flows. There's always a risk in that. Some projects are riskier than others. We don't know what the risk is in this project. They've told us nothing about it. But basically, the more uncertainty there'd be the more risk. And this little symbol right here is basically your risk. It's standard deviation. And so basically, we're measuring by the standard deviation of the NPV, the IRR, or it's also called beta. Beta is a measurement of risk using standard deviation. So basically the question then is, does this project increase the overall risk of the firm? Yes or no? We don't know because they haven't told us that, but that's part of the equation is, does this add to risk of our business? And if the answer is yeah, then we might consider having a higher WACC to adjust for that. Okay. It says here, is risk analysis based on historical data or subjective judgment? A little bit of both. A little bit of both. It's usually based mostly though on subjective judgments. So the hard part with cash flows is it requires a lot of future estimating and a lot of future guessing based on experience, based on what you know about your business, based on what you know about the industry, and so on. So there's 3 kinds of risk to factor in: standalone, corporate, and market or beta risk. Standalone risk is the project's risk if there was only if this was the firm's only asset and there's no shareholders. So it kind of ignores diversification. Basically, what's the risk of this project all by its lonesome? Okay. Now that's generally not what you can really take into account, because most companies have a portfolio of projects they're working on and things that they're doing, and clearly every firm has owners, private owners or stockholders, whatever that is. And generally, you want a well-diversified portfolio of projects. You want some that are a little bit riskier, you want some that are really safe, and some that are in between. But standalone risk is just, what's the risk of this project in a silo all by itself? And corporate risk is essentially the risk of the business. Clearly, some businesses, some industries have way more risk than others. I could pick on airlines, car manufacturers. Clearly, if the economy is doing well, people have more disposable income. They believe that the outlook is bright. You're more likely to spend money on a vacation, to travel, to buy a newer vehicle. If the economy is not doing well, generally you cut back. I'm not going to travel. I'm not taking the vacation. I'm not buying a new vehicle. I'll buy used or just try to get the current vehicle I have working good enough. So that would be risk, right? That'd be some industries just bear more risk than others just by the inherent nature of doing what they do. And market risk is just essentially, what is the risk of this project when you combine it with the risk of every other project in the company. So it's like a portfolio of projects, just like an investor could have a portfolio of investments. And if you have a portfolio of investments, generally you have a few riskier stocks in there. You've got a couple of safer stocks in there and some that are right in between, just that diversified portfolio, right? So you don't have too much risk or too little risk to get that right return that you're looking for. Same thing here. It's just basically, what's that portfolio of projects we have within our company, and how does this new venture affect that overall risk? And you want to kind of just stack that up against the current projects you have and go, is this make us more riskier overall, less riskier overall, or about the same. So just taking that into account. It says here market risk is typically the one to focus on the most. However, creditors, customers, suppliers, employees are more affected by corporate risk. So they say that corporate risk is really more relevant. So that's the one that most companies kind of focus on because you have to answer to your stakeholders, right? Anybody's lent you money, your customers, your suppliers, your employees, your owners, they're all stakeholders in your business. They want you to succeed and do well because they need you, right? Employees want a job. Customers want your product. Suppliers want to sell to you. Creditors lent you money. They want it back. So they're all very dependent on you for one reason or another. And they don't want you going crazy typically, right? So they're going to focus on that corporate risk and basically say, how did this project affect your overall corporate risk? It says here, how is each one used? Standalone risk is easiest to measure, more intuitive. I can measure that with a real number using NPV or IRR. Core projects are highly correlated with other assets, so standalone risk generally reflects corporate risk generally. If the project is highly correlated with the economy, standalone risk also reflects market risk. So it kind of just depends on this project. What's the nature of the project? Is it something that's pretty common for us to do? Is it very unusual? Is it really risky, not risky? That helps us kind of figure out too which of the three types of risk might be the best to use to look at it too. Sensitivity analysis is basically saying or playing the what if game. Okay, the what if game. What if this one variable changes? How will that impact NPV or IRR? And the nice thing about using spreadsheets to calculate these types of things is the what if game of sensitivity analysis is really easy to do because I had the base case example of sales were going to go up 6%. Well, what if sales went down? What if we didn't know that the competition was thinking of doing the exact same thing we are? We didn't know that. And a year later, they launched the exact same product. Maybe they undercut our price. And we're like, sales are going to go down, right? Sales will decrease. So maybe we want to factor that possibility in and go, what if sales decline by 30%? Would we still have a positive NPV or IRR? If the answer is yes, that makes us feel better about the project. There's less risk in the project than if it could withstand that kind of a sales hit and still survive. And so that's just looking at how will things change. Sensitivity analysis is how will things change based on that, and what's the resulting NPV if that changes. So if sales go down 30% from the base case, what is the resulting NPV? So that's really what we're looking at here. So if sales go down 15%, if they go up 15%, they go up 30%, how will that impact our analysis? Steeper sensitivity lines, if you were to graph them, would have more risk. Small changes result in large declines in NPV. If unit sales line is steeper than salvage value, we'd worry about an accurate sales forecast. So just really what you do is you graph it, and that graph will kind of show you what the sensitivity and the risk is. Now, the bad thing about sensitivity analysis is it's not perfect, because maybe more than one variable will change. It ignores relationships among variables also, and it does not reflect diversification because it kind of just pretends this little factor happens in a silo, and this factor changing may also be bad or good for other things that we're doing in our business too. We just don't take that into account though typically. But it gives us some idea of standalone risk, identifies what the dangerous variables are, and also helps figure out what maybe what the break even is. So as long as I'm breaking even, I'll be okay. That's usually what you think. And scenario analysis is looking at what's the worst thing that could happen, what's the worst case scenario, what's the best case scenario, and what's kind of something in between, giving us a range of outcomes. And so we can kind of do the same thing. We can apply probabilities to this, which are very subjective, by the way. And if we sell more units than we anticipated, so remember the base case is built on 1,200 units, but what if we sell more than that? What if we sell 1,600 units? Well, what if we say there's a 25% chance of that happening? The NPV will go crazy. It'll be 279. The base case, we say there's a 50% chance of that happening, and NPV is 88. And the worst case scenario is sales are only 900 units, in which case we would actually have a negative NPV. So what you can do is do the sum of that, compute the standard deviation, and calculate essentially what the beta is, and that's 1.15. And 1.15 means there's a little bit of risk in that. A beta of 1 typically just means just neutral for risk. So above 1 means there is risk. Less than 1 means there's not as much risk. So it's a little bit risky. It's a little bit above 1. Okay. And of course, with scenario analysis, it's not perfect. Those factors, those weights we applied here, 25, 50, and 25, are very subjective. Very, very subjective. So who knows what they will actually be. Only considers a few outcomes and so on. And of course, it ignores correlations too, which may or not be true. And the last thing is real options. Options are things we can do while the project is underway to affect it positively, or negatively maybe too. But what if the initial first year or two the sales are not what we want? We're not selling 1,200 units. What can we do? Well, real options would be, can we reduce the price? Can we focus more on better advertising? Can we somehow work to reduce the cost and our net cash flow is the same? That's what real options are. What are some actions that we can take during the life of the project to make the numbers look better, make them come out better? Okay, so that's really what the point is. Of course, the more options we have, the better off we are. So investment timing, expansion, new product lines, new markets are all kinds of options we can look at too. And sometimes it's a matter of abandonment. Maybe it's, we don't want to throw good money after bad, so we just say, not worth it. This is not going to work for us, and so we get out of it and we stop. So that's sometimes an option too. And sometimes maybe you try to build in some flexibility too. What are some things I can do to impact the project positively while it's going on? Okay, so hopefully that all made sense. If you read the chapter, that will really tie into what I just got done talking about here. So read the chapter. It's very important that you do. That will help you a lot in terms of answering some of the quiz questions and doing the homework for the week too. So this, along with the reading the chapter, is what you need to do. And there's another video that I'm going to do also that will kind of walk you through some Excel files. Thanks.